For years, the mortgage industry has relied heavily on traditional credit scores to evaluate risk. And for the most part, that system has worked. It gave us a standardized metric to judge an applicant's likelihood of paying back a loan. But today, there's an increasingly important conversation happening around the borrowers who may not fit neatly into these traditional scoring models. Because the simple truth is, not everyone builds credit the same way. Think about a borrower who pays their rent on time every single month. They pay their utilities on time. They pay their cell phone bill on time, and they manage their day-to-day finances with incredible responsibility. Yet when it's time to apply for a mortgage, they discover they have a limited credit profile, what we in the industry call a thin credit file. And that creates a vital question for lenders and originators. Are we always seeing the full picture? Historically, traditional credit scoring models have relied almost exclusively on information reported through conventional credit accounts. We are talking about credit cards, auto loans, student loans, and standard installment debt. But not every financially responsible person uses those products in the same way. Some consumers intentionally avoid debt as a lifestyle choice. Others are younger borrowers, like recent graduates, who simply haven't had the time to establish extensive credit histories. Some are lifelong renters who prefer to keep their liabilities low. They consistently demonstrate responsible financial behavior, yet the traditional system essentially penalizes them for their lack of debt. This is precisely why we are seeing a massive shift throughout the industry toward expanding visibility into borrower behavior. To be completely clear, this isn't about replacing traditional credit evaluation, nor is it about lowering underwriting standards. The goal is improving our depth of understanding. Mortgage lending has always been and will always be about evaluating risk. The better and more comprehensive the information available, the more accurately housing professionals can assess that risk. That's why alternative data is no longer a concept for the future. It is happening right now. For example, major institutions like Fannie Mae and Freddie Mac have actively updated their guidelines to allow automated systems to look at positive rent payment history. Through secure permission-based cash flow analytics, technology can now scan 12 months of bank statements to identify consistent on-time housing payments. Furthermore, the industry is transitioning toward newer scoring methodologies such as VantageScore, which are specifically designed to more accurately score millions of previously unscorable consumers by utilizing these broader data points. This means that if a borrower has a thin file but a flawless track record of paying rent or utilities, that data can be leveraged as a positive indicator. And the best part? These frameworks are built to be positive only. If data is missing, it doesn't penalize the borrower. It simply reverts to standard evaluation. The industry is asking the right question. How do we identify borrowers who are financially responsible but invisible to legacy credit models? The future of mortgage lending isn't about finding reckless ways to approve more borrowers. It is about finding smarter, data-driven ways to understand them. The professionals who stay informed about these structural shifts will be the ones best positioned to help modern borrowers navigate an evolving lending environment. Because sometimes the challenge isn't whether someone is creditworthy, it's whether our system is smart enough to recognize it. Like this video, and if I taught you anything, click subscribe or follow to be sure you can learn more to help set yourself apart.